Yields are continuing to rise after Fitch said, despite the debt deal passage, it will keep the U.S. credit rating on negative watch. So are we or are we not in a Goldilocks scenario? Let's get right to the floor show. Trader Keith-Fitz, Gerald, Stifel chief economist Lindsay Piegza. Lindsay, this market is taking off, even in light of the fact that we have this unbelievable payrolls number. Now, manufacturing payrolls declined by 2,000 in May, but 257,000 of the 339,000 jobs created during the month were in the private sector of the business world, service business. Interpret what the Fed is thinking right now. Is it, we have to raise interest rates again at the next meeting?
You're right. We did see some underlying weakness in manufacturing and information services, but broadly speaking, this was a very solid report. As you mentioned on the onset, well surpassing expectations and putting pressure on the Fed now to continue to act. The Fed did indicate a willingness to move to the sideline, at least temporarily, later this month, and they still may do so. But any decision to implement a temporary stay in terms of further rate increases will be made in spite of the data, not because of the data. When we look at the still elevated level of inflation, when we look at this morning's very robust labor report suggesting a tight labor market is becoming increasingly more tight, it's going to be very difficult for the Fed to justify a pause, let alone ending any further policy action.
You broaden the discussion out to what is going on right on our screen, Keith. The Russell 2000, small and mid caps, up 3.25%. Then you've got the NASDAQ up about 1%. S&P hitting a brand new high just a few seconds ago, up 68 points. And the Dow Jones Industrials up 2.25%, high at the session, 736 points. What do you think is the real driver here?
Well, two things. First, people are saying, hey, how cool is that? And second thing is we actually might have a path out of this mess.
What's cool? The jobs number?
Well, the jobs number, the fact that the Fed might finally get its act together, the fact that we've got a debt ceiling agreement, the fact that people are realizing the light at the end of the tunnel is not an oncoming train. I mean, the list is long, even though it's not distinguished. So this kind of upswell is absolutely normal. It's consistent with a market that wants to go higher. I think being on board is pretty cool.
Okay. When you're on board, I want to remind our viewers, Keith was the guy who, I think it was last summer when some of these names were hitting 52-week lows. You were piling into Apple. You were steady, constantly scooping up shares of NVIDIA. Have you sold any of those? Because right now you've got Apple, Meta, Microsoft. I know you like Microsoft. Those are hitting 52-week highs right now.
Well, I tell you what, you're very kind for remembering that. Thank you. This is a tough business, and it's always nice to hit one out of the park, or even a couple. But no, I haven't sold a single share except for NVIDIA. I've taken a little off the top, but redeployed that into Apple. I think all those stocks have a long way to go. I've bought some AbbVie. I bought some other large caps because I think this market wants to run, and I want to be ahead of that.
Yeah, you're not even breaking a sweat. You're still going there. Lindsay, which sectors do you think have real opportunity here? I was coursing through all of my sector stocks, and I looked at hospitals. They're moving higher. Airlines, big financials, European banks, insurance names, most of the metals, healthcare, drillers, brokerages. It's a big day here, but does it last, considering Fitch, for example, is not lifting that credit watch negative on the U.S.? We got extraordinarily close to the June 5th deadline for this debt ceiling deal.
Well, aside from the credit watch, I think we have to look at the longer-term sustainability of the economy. Right now, with the Fed continuing to raise rates, presumably in its fight against inflation, the economy is likely to slow. Now, most economists, ourselves included, have pushed out that recession call to the end of this year or early 2024, but the weakness is already very much in place. So when we talk about deploying capital, looking for those areas of opportunity, we have to put it against the context of a slowing or weakening economy. So we're looking at areas like staples, utilities, consumer discretionary, areas that are likely to maintain at least some level of momentum, even as that top line GDP picture begins to deteriorate into the second half of the year, or again, as I mentioned, into early 2024.
There's always the belief, Keith, that the markets are ahead of the economy by a few steps. I do want to keep our eye very closely on the S&P 500. Just a second ago, it hit a fresh high. Folks, 69 points to the upside. I believe at the moment it's up just about 68 points. So at 69 points, it's 2 points away, just a bit over 2 points away from exiting bear market territory. why not sell more? I mean, you say you're continuing. You haven't sold a single share of Apple. I know Apple has its worldwide developers conference on Monday. It could be unveiling its AR VR headset. That may be a big catalyst. Is that why you're not selling any Apple?
No, it's actually something that Lindsay mentioned just here a minute. Very, very sharp point. You've got to be very careful which names you stick with. If the economy is going to enter a recession, I want to focus on the companies that are going to grow anyway. The companies that we've just talked about, Apple in particular, is going to grow practically no matter what the economy does next, practically no matter what the Fed does next. So those are the kinds of things that are very attractive to me, not only because they can grow, but because of the source of stability if there is a recession. I think we've been in one and we're exiting it, frankly.
Keith, thank you. And Lindsay, great to have you.